what the world's biggest banks have in store for the US dollar. Central bankers from Beijing to Brasilia have been acquiring a lot more dollars of late, but the overweight of the greenback has reached its limits. There is only one way left to go. It is time to sell the dollar once again. Also says Jerome Booth. Booth has been in the currency and fixed income markets since 1999. The test when he helped launch the Ashmore Group, one of the largest pure-play emerging market fund managers in the world with around $70 billion under management. Before he retired to write books and launch his new private equity firm New Sparta Limited, Booth was a regular source of mine here at Forbes. He did talk about the wonders of emerging market debt, their relative strength compared to the Western world and how they've improved from their third world days of yesteryear, and the day of reckoning that would come when the Chinese yuan becomes a reserve currency. The International Monetary Fund will vote on that in December. That's just one of the variables that has the dollar bull run unlikely to last a year. In the short term, the dollar's problem is not the yuan. It has a 25% gain against the euro over the last 12 months, with investors wondering if it's reached its peak. The guys who think it is not are winning. And those guys include the central banks of the developing world. The currency composition of reserves in emerging market central banks has shifted slightly from euros to dollars from 62.4% in dollars to 62.9%. The dollar is looking toppy, a good level to take profits, says Booth. Dollar panic selling is possible given the homogeneous structure of the investor base in externally held treasuries. It has not in Barclays and number 039 hands. It has not in Goldman Sachs accounts. Treasuries are sitting in the People's Bank of China. Trillions of them in fact. As they are in the Russian Central Bank, the Reserve Bank of India and every other major emerging market that requires a nice reserve cushion to save itself from the Western world's short sellers who like to watch a nice currency bloodbath from time to time. So far this year, there has been a consensus view that the dollar can only go up. Interest rates are going to rise at some point later this year. Everyone and their mother will want higher yielding US debt. Treasuries will have many buyers. That's the gist of it. But when the dollar falls, it will be because the surplus central banks have determined they have to shed some weight. Booth even goes so far as to say the central banks could dump all at once. A rush for the exit by them could cause a dollar crisis similar to that in 1971. They may lose a third of the value of their reserves in the process, but deployment in crisis is what reserves are for. And there comes a point in any trade when cutting one's losses is preferable to pouring more good money after bad, he says. Dollar, bad? No. Dollar weakness is not solely resting on the whims of central bankers outside of Washington, even Booth knows that. If major bond and currency traders don't get spooked by China and Russia converting to another currency, including gold, then the dollar's decline will merely be gradual. If not, then all hell breaks loose. Fortunately, two things are on the side of a gradual shift. First, the conventional view of the world is so skewed that most market participants don't perceive the threat to the dollar from emerging market central banks. In other words, a herd mentality is unlikely even if Russia and China were to sell dollars. Secondly, as has happened in the past, central banks can control market expectations by intervening to slow appreciation of their own currencies, making comments to the press about how they don't want their currencies to rise too fast. In that case, they will be busy sucking dollars out of their local markets and dumping them into their reserve fund. China, good? Depends who you ask. Depends who you ask. The pace of any gradual change in the dollar will be driven by China. Beijing is increasingly confident the yuan will be part of the IMF's special drawing rights next year. Once that happens, it opens the possibility for other central banks to start buying Chinese yuan. In theory, that will either slow the pace of dollar buying, or reduce dollar positions altogether in favor of Chinese debt. Most in the market see that at least 5 years away. However, as China's bond market is not fully opened, there is only so much yuan assets a foreigner can buy. The China death knell, in other words, is just fodder for...
Please subscribe to us on YouTube, Facebook and Twitter. You can visit us on www.therealthingming.webs.com.
We